Okay, welcome to our first session for June. What a week it has been. I think the week started with a bang. Friday was amazing. I hope it was amazing for you as well. Bob says nice day finally. I mean the whole week it's been crazy. For only the day, and I can't wrap my head around it, but I'll take it. I won't complain. But pretty active, or I would say pretty lot of news in this week. It's a lot of earnings also happened, and we're going to go through some of those earnings. There are some stocks that are being favored by AI and retail investor. So I spent some time looking into that. We'll go through the earnings. We'll go through what the heck is hold this debt ceiling. Eventually, what happened, or probably nothing happened during the debt ceiling. Looks like mostly eyewash. So want to dig deeper into the bill of debt ceiling. What's a compromise? And after a long time, now we have an IPO market a little bit heating up. I wouldn't say heating up. I mean, we haven't had IPO for very long time, and now we saw one more company filing for an IPO. So want to review its pre-IPO, it's a S1 document. That's a lot of stuff on agenda. Maybe 2 hours may not be enough, but we'll see how much we can get through it. It was gloomy down here last day. Oh, okay, nice day. Oh, I think, referring to weather, cool. It's been pretty, out here has been pretty okay. Market wild run. Exactly when, and I think if anything market did this week after the JOLTS report, it was probably a surprise for everyone because anyway, we'll go through it, but the general wisdom, if you had used the general wisdom saying that the employers added more employees than expected, we should see the Fed tightening and the market should sell off. That's what market had been doing over the past many quarters. Is good news for economy or good news for employees is bad news for market, but not this time. So it's impossible to predict what market will do depending on what's news. So anyway, but I'm not complaining at all. Will take all the gains that market is giving. Only thing is, how long can it continue to do that? That's a little worry. So I'm still holding my hedges. I'm still holding those. I'm not yet, closed my hedges. It's partially hedged, so that's okay. All right, so let's dive into today's session. A lot of stuff to cover. So starting with the debt ceiling drama. Yeah, I found a few, nice, funny cartoons to go over that. I found this happens every year, raise it, cut spending, and while the American public and the rest of the world is, what the heck is happening in this country, right? Every year we go through this drama. So it looks like now we have put it, at least this year, we decided, okay, no more drama next year. So it's, and like I said last week, there are 4 ways to address the issue. One was to issue $1 trillion coin, even though it looks like a joke, but technically this could be done. Or to use 14th Amendment and say, okay, default is unconstitutional, so we will continue to raise it, or US defaults, or a miracle happens. Eventually, miracle happened, and every time it's the same story. We'll see market getting little jittery about the debt ceiling, and then eventually a deal will be reached. So this week also we saw finally the deal was reached among both Democrats and Republicans. So what's the deal? When I looked into the details of the deal, I'm like, what the heck is happening here, right? The deal was to suspend the $31.4 trillion debt limit through January 2025, right? The problem is not the debt limit. Actually, the bigger problem is our spending, the way our country is spending. That's the problem. Debt ceiling is just a symptom that, hey, we have reached our spending limit. And now we've actually removed that limit itself. We kind of suspended that limits, saying we'll not talk about it until January 1, 2025. And we've been doing this for like almost 80 years. Ross says the debt ceiling talks are just distraction. They're diluting social programs behind the scene while defense lobby is popping champagne. Exactly. So if we look into the details of what's happened in the deal, except the defense, everything else has been, let me put it this way. Defense has not been cut because that is considered as a non-discretionary expense. Military industrial complex, they got a big lobbying. So defense lobby is happy, whereas all other social programs, a lot of other social programs have been cut. So we'll look into the details, but yeah, you're right. That's it's a distraction, and maybe we should just use 14th Amendment and say, hey, we're never gonna talk about debt ceiling anymore. But I don't know how the rest of the world is gonna view that. So, but there is no point in raising every year, going through the drama, and then continue to raise the debt ceiling. So somewhere this is gonna bite us. I don't know when, 20, 30, 40 years. We don't see the demand for the US treasuries from other countries is not as much as what it used to be. So we are seeing other countries reducing their holdings of US treasuries and expanding into other assets as a part of their forex, as a part of their reserves, right? Gold, maybe a little bit of a euro. I agree, USD is still the largest one, but rest of the world sees this drama and like, hey, this household doesn't know how to manage their finances, right? Every time we hit our credit card limit, it's just like you have a limit on your credit card, and then you're close to the maximum limit of your spending. And then you say, oh, the problem is that I have a limit on the card. The problem is not that I'm spending too much. And this is what exactly is happening here. Every year, we keep on raising the limits on the card and continue to outspend our way. Vivek, rest of the world has been sponsoring. I don't know. I mean, probably they'll still do for some more time, but we'll see.
China used it to their advantage. They sold their exports to us, and then they bought the treasuries to keep our interest rates low so that U.S. could go on a credit fuel spending waste.
Yeah, so but that's what China used to do is, you're right. All the exports, they got dollars. They didn't want to repatriate dollars. They bought treasuries, and using those, or either they bought treasuries or they bought a lot of real assets in US, like properties and all that stuff, real estate in US. They also, a lot of countries also bought stakes in US companies, whereas we got cheap TVs and plastic toys. But now with a lot of our own companies, US companies, looking to diversify their manufacturing outside of China, even China will be purchasing less.
That's BS. They said that 16 years ago, they said China's government is too aggressive, so let's diversify. So they talk a lot, but they don't do anything.
This time it's not because of the government. I think the COVID taught the companies a lesson that we need to have alternate supply chains. So I don't think the view about the government has changed. So that's still the same. I mean, Elon Musk made a trip to China recently. Tim Cook made a trip. But I think a lot of companies are looking at the fact that whatever happened during the COVID shutdown, we need to have not the cheapest supply chain, but we need to have a more resilient supply chain.
Well, Vivek, those are the people that have to kiss butt with the Chinese government.
Yeah.
I mean, there's hundreds of other companies that can move out, and some have.
And some of even the bigger ones have been diversifying, right? Look at it, even Apple. It's still the biggest one is still in China, but they also started opening up factories in Vietnam and in India.
So do you know anything about what's that shoe company? Balance, something Balance, New Balance. They used to have a lot of U.S. operations and China, and then about 15 years ago, they were deciding whether to increase China and reduce U.S. But as a result, the U.S. sneakers are sold as a premium in China. I don't know what their mix is now compared to 15 years.
No, I don't know the mix, but one thing which at least we notice is we want to have more than one way of in our supply chain, just based on what COVID had done. So in any case, we are seeing even if we look at the reserves of all these countries, the total amount of reserves, the dollar amount of reserves, treasuries is becoming, it has been going down, right? Nowadays, most of the treasuries have been bought by our own Federal Reserve because other countries are not buying it in the same volume that they used to buy. So it is rest of the, I don't know how long rest of the world will continue to sponsor us. The appetite is reducing a bit. It is still the don't get me wrong, I think this is US dollar is still the reserve currency of the world. This is still the most held currency of all, but the overall percentage slowly is coming down. It's not going to happen tomorrow. It's not going to happen in 10 years, but it will be 20, 30, 40 years, right? With now it's a break and I think plus something, right? Those emerging economies, the consortium of those emerging economies now bigger than G7, the overall their GDP. So new trading blocks are being formed, new trading consortiums are being formed, which may want to diversify, and many of those, they do want to diversify themselves out of dollar. It's not easy, but the fact is now there are countries who want to do it. Whether they will be able to do it or not, that's still questionable. I don't know how many countries can get out of SWIFT without a viable alternatives. How many countries can get out of US dollar without any alternatives? But the fact that they want to look at alternatives does say something. And these things will take decades to change.
Vivek, this morning I read something that China has developed an alternative to SWIFT.
They do. Even Russia.
I just read it.
Yeah. So Russia and China, they both, after Russians assets, dollar-based assets were seized by US government, there was a news around both China and Russia. There is an alternative to SWIFT, but the percentage of the transactions on that is fairly small, very small, right? And we do know that also China has been trying to force a lot of other countries to deal in RMB, but hasn't been that successful. So whole idea is they do want to diversify, Whether they'll succeed or not, it's yet to see. But the fact that countries are looking and thinking that US is not the only one, we need to have another alternative currency as a global currency to trade, itself tells that, winds are changing. And over here, with the way we are raising debt limit and assuming that the world will be able to always supply us is mind-boggling. So we suspended the debt limit. So nobody is going to talk about any debt limit anymore, right? Till January 2025. So you can spend whatever you want to. All right. So this is a chart showing around overall debt limit and the public debt. We hit $31.4 trillion will be till Jan 2025. So what happened in this deal? What all we got? It caps the non-defense spending, right? Like Ross was saying, the defense lobby is popping champagne. Yes, because they haven't been cut, but it capped the non-defense spending, which will be barely increased by just 1% in 2025. Right? 11 billion will be clawed back from COVID-19 relief funds. 10 billion dollar will be shifted from IRS service. So if you recall, there were IRS was granted a bunch of $1 billion. I don't recall right now, but we discussed in one of our previous sessions to hire another 80,000 IRS agents. And recently there was a news, I think it was last week, that IRS will be creating their own system so that we can file taxes for free, right? And on that news, some of these Intuit and other tax prep companies shares went a little down. But now this $10 billion will be shifted from IRS. So who knows? Now IRS will not develop that that free software for tax filing anymore, right? So that would bode well for companies like Intuit or H&R Block, and etc. I see a comment from Ross. Government Treasury issue bonds, Fed buy the bonds, definition of Ponzi scheme, but who cares? Exactly. It's like from one part of the government is issuing the bonds, the other part of the government is buying the bonds. Eventually, the value of the bonds will, the value of the dollar will continue to decrease. The right way is to cut down some of our spendings and the benefits. It's a difficult decision to take, but who wants to do that? Right? We continue to spend so much on defense. It's difficult for any politician to, or any party in power to come and say to retirees, saying, hey, we'll have to pay you less Social Security. It's just not viable. I mean, it's not, you won't be in a power. So we will still say he will pay you full Social Security, but what they don't say is that won't be worth as much as what it is right now, right? So, and if you are only counting that the dollars is safe, which is what most of the general population will do, saying, hey, let's keep money in the bank because at least I won't lose money. So far, I mean, this year turned out to be a little different, but what we don't know is the inflation eats away our purchasing power anyway. So politicians will pay Social Security, but that won't be worth much.
Does Modi have to deal, or whoever the Indian leader is, have to deal with this local concern?
So there is no concept of Social Security in India.
Oh, okay.
So in India, you're on your own. I mean, I don't know about now, but while we were growing up, there was no concept of government taking care of you in past. So while you're earning, you do put some of your money into what call your retirement funds, and then you get money from that. But there is no like Social Security if you haven't contributed. It's basically you put money in your own pension scheme. I think over last 10 years, those who are not in jobs, there is something called NPS. And again, I don't follow Indian market anymore, National Pension Scheme, so that even those who are doing business can put money in some pension scheme, but there was no concept of social security. So that's the reason in some of those countries you will see there is a lot more tendency to save, because we've seen our parents, we don't save, there is no one to take care of you when you're old. So that's why you would see Indian that's a lot of basically Indian community are big savers, because that's how they grew up. That's how their generations above them grew up, that if you don't save for your old age, you don't save for your retirement, then you're on your own. Intuit is lobbying extra, not good for the rest of the plebs. Yeah, Intuit always does that. I think there were even earlier also there were some bills that were proposed for IRS to create a tax return, and then individuals can confirm if they agree to that return or not, right? And this is what's most surprising is IRS has all the information. They know exactly what tax we are supposed to pay, but then they still want us to file the 50-60 pages and submit it to them, and then they'll tell us, oh nope, you owe this much extra, and then we go back and pay again. Why all that crap? But there have been attempts by lawmakers to change the process, saying IRS should create a return, and then as an individual, I could go and say, yeah, I agree with it, or I don't agree with it. I can dispute that return. Makes the whole process much smoother, but the lobbying by Intuit just killed that. So because they lose their whole TurboTax business if IRS, if we don't even have to use it. We'll agree to, most of us probably will agree to what IRS would have said anyway, because our financial lives are easier. If you want to go and dispute, do that. But yeah, Steve said, but they'll delay the retirement age to a degree that Social Security will be paid just one day before one dies. Yeah, that'll be the worst. So you contributed to whole your life and didn't get anything. Yeah. So they have Provident Fund like 401k here. Yeah, so again, those Provident Fund and PPFs, some of them have limit, PPF have a limit, PF does not. But again, those are like not Social Security. Yeah, those are like 401ks. Jay said they issued 3-day bills to borrow from Friday to Monday this weekend. Oh wow, I didn't see that. Gosh, that could have been a nice 6.25 just for 3 days. What a stage our government has come to. We don't have money for the next 3 days. Why do UK, Belgium buy treasuries? I don't know, but how much is the overall percent of the treasuries? Let's say treasury holdings by country. Let me just search major foreign holders. Okay, this is what our Treasury Department says. So from Jan 2022, Japan has reduced by what, 100 billion to $200 billion. China is down by $200 billion. UK has slightly increased. Belgium has slightly increased. Yeah, Luxembourg has yeah, $5 billion, doesn't matter much. So, but if you look at overall, grand total is $200 billion less. So anyway, just IRS doesn't have all the information, especially if you have a business. Yeah, I think business could be different, but W-2 brokerage firm, W-2 accounts, bank account, interest accounts, your brokerage and all that stuff, that IRS have the information, or they can get the information. Business, I understand. Anyway, so this drama continues. What additional funding will come from IRS, then $10 billion from other mandatory programs, $23 billion from emergency funding, but no change to the defense spending. They'll also protect veterans' medical care. I like that. I think that's the right thing to do. Expands work requirements. I was like in a double mind around that. So this is basically for those who are receiving the food stamps. There is a requirement that if you're an adult between 18 to 49, you are only able to get a food stamps, for 3 months out of every 3 years, unless you're employed for 20 hours a week. Now they want to expand from 49 to 55, which not too mad about it. I think 55 is still an age where you're able-bodied, physically you can still work. So I am okay with it. Clause back some COVID-19 relief funds. I think I'm okay with this. There's been a lot of scams happening around this whole COVID relief. We don't know where all the trillions of dollars actually went in. Is every money accounted for correctly? Probably not. Cuts IRS funding. We already discussed that. Restart student loan repayments. I think that's the right thing to do. Maintains climate and energy measures. That's fine. Expedites pipeline in West Virginia. And then we saw after this, one of, I think, energy pipeline company stocks were up like 50%. Right. So eventually, it was a compromise, like happens every year. And everyone looks like everyone got everything. Oh, sorry, everyone got something. So I found a nice cartoon. I forgot what it's called when no one gets everything, but everyone got something. This is called governing. And that's exactly what we saw the previous week was, yeah, there's maybe something for everyone for the short term, but eventually we'll have to pay for this excess spending, right? Either by cut in the benefits, cuts through in the social spending, or this may be the better representation of what might happen is we'll take out our back pocket by higher taxes. So that's all about debt ceiling. I thought probably we will reach some more sane result, but so far only thing we did was let's kick the can down the road. It doesn't become an election topic as well, because now this is post-election. So we'll go back to in 2025. So I guess next year, no such drama, no such debt ceiling. Treasury can issue whatever bonds, etc. they want to. Steve, every rate is pegged to 10-year Treasury. If the Treasury is going up, a lot of companies trying to refinance, will go belly up. Maybe IWM is a target to short. Whether the Treasury, so it is possible. I don't know whether, treasuries were already yielding what 4-5% plus. My recent one, which got on the end of this previous month, and it was on reinvested, I think it's more than 5%, 5.2 or something. So treasury is already high. Can it go? I don't know whether it'll go further high or not. I don't think so. I think it's already 5 plus. It'll just gonna kill the economy. I did a bunch of treasury auctions. So I do have my T-bills ladder, like 17. I have a bunch of 17 weeks. And then I think a couple for 26 weeks, one for a year, and one for 2 years. So I have like 7-8 of these T-bills ladders built in. And the recent ones on 16th of May, and then the one which is at the end of May, both of them were, when I renewed them, they yielded more than 5%. Right? So I'm like, okay, I'll keep it in treasury for another 17 weeks. Right? So another interesting chart was, why is this urgency around the whole debt ceiling, right? Because the US Treasury account has been depleting, and that's why it looks like they had to do a 3-day emergency funding program so that Treasury can continue to pay. So now, with the debt ceiling, agreement between the two parties around debt ceiling, come Monday, Treasury is gonna refill its coffers, right? And that could do another damage to the stock market. Again, it's not me. There's no, I can't predict where the market will go, but if you listen to the so-called more saner heads, or those who are more active on the financial markets, what they have to say, one thinking goes this way, saying, hey, markets were all up this week, thinking we reached a debt, we made a compromise on the debt ceiling, US won't default on its debts, and that's great, it's bullish. But what happens from next week when they start to raise, when Treasury start to fill in its coffers, right? Maybe, I think what's expectation is that Treasury will need around $1 trillion to fill in its coffers. So they're gonna unleash a tsunami of bonds or bills to get that money with Treasury. And where's that money gonna come from? Now, if that money is coming from the banks, that the banks are starting to now park that money with the Treasury by buying bonds, that will cause another liquidity crunch in the market, because banks are a source of liquidity. So that will be a drain on the liquidity. And as we know, stock market doesn't like liquidity crunch. So there are some estimates from, let's say, JP Morgan's and Citigroup and all that stuff, is the flood of treasuries will compound the effect of QT on stocks and bonds. Right? On one hand, Fed is not injecting any more liquidity. They are on so-called QT. On the other hand, Treasuries will be issuing a lot of bonds. So if Fed is not buying, and if banks start to buy it by using their deposits, then that will mean less money to be used somewhere else. So it could possible, saying maybe, the market could have an impact of maybe up to 5%. Some Citigroup strategies ran their models. They're looking at a drop of maybe 5.4% over 2 months. Again, I'm not predicting anything. Market has a tendency to surprise all the time. But the fact that this money has to come from somewhere, and if this is coming from the banks, then we'll see the crunch, and that may not be good for the market. Anyway, so this is another chart, is US money supply projected to decline further. And as we know, markets doesn't like crunch in the money supply. So be careful. That's why I'm still holding my hedges. There's no point. I mean, markets are up already. What? S&P is up 12%, 13%. I think I have a chart. Maybe around 12%. QQQ is up like 35%. A handful of those AI stocks. We'll review some of them today. But that's like too much too soon, and too much of optimism on the debt ceiling, that we reached some pact, and that's great for the markets. But let's wait and see what's next. When these bonds will come into the market, who's going to buy these bonds? How are these bonds being funded? There are a few thoughts around it. If it is being funded through the repo market, probably we may not see that much of impact. But if it is funded through the bank deposits, that's where the liquidity crunch might come on. So there is nothing certain about it. It all depends on how the money is being moved out of the, which money portion of money is being moved out of the system to purchase these bonds and the bills. So we'll wait and see. See a comment from Steve. The Treasury is considered a risk-free rate. If the Treasury is up, the credit rate, mortgage rates are all going up. Yes. So all other rates are tied to, so it's generally not Treasury, it's a Fed rates, right? So, and all rates will be tied to those Fed funds plus something, plus 2%, plus 3%, your HELOC, your credit, your mortgage, everything will go up if the Fed funds rate continue to go high. I heard the risk-free rate refers to 3-month T-bills. I'm not sure it is the 3 month. I know that the mortgage is tied to 10 years. I don't know about the others. So yeah, all different durations are considered to be risk-free. A lot of new bond sales mean bond prices go down and rates up. So depending on at what, my understanding is depends on at what interest rate these new bond issuances are, right? If the new issuance is at a higher rate, then the existing bond prices will go down. But if it is from at a lower rate, then the existing one should go higher.
If they have auctions, though, the rate is set by the investors, right?
Yes.
So in the auction, if they issue, let's say, double and triple the usual amount, then there will be less bids, which means prices will be a bit lower and the yield higher, right? If next week they issue like 4 times the amount of the typical auction, my thinking is the yield will be higher.
Yeah, then probably if they have, if Treasury is in such a desperate situation that they need to raise 4 times what they've raised in a previous weeks, they will have to make it a lot more attractive. And you're right, in that case, the yield will be higher, and the yield will be higher for the newer ones, right? But
yeah, but they adjust across the board because the secondary market stays in line with what happens with the new ones.
So then the bond prices in the secondary market, those prices will go higher because those bonds are offering no, it will be the reverse, other way around. If these yields are higher, and then those the bonds market prices should go down, the existing in the secondary market, because they will move inversely of the yield. At this rate, QQ will be up 100%, more than 100% by the year end, I guess. Yeah. All right. JOLTS report, we added 339,000 jobs in May, which is way higher, almost double, close, like say way higher than what was expected. But on the other hand, the unemployment also rose from 3.4 to 3.7%, right? Which is a little head scratcher. How could both the things be happening together, that you add a lot more than you were expected to, and then your unemployment rate also went higher, right? And that's the beauty of how we calculate unemployment. And the reason is that the people who are sitting out, the job quit rate is slowly coming down. So now there are more people available who wants to have a job. So that means they do now start to figure in as an unemployed, which earlier they were not. So even though we added more jobs, the unemployment rate still ticked higher. So I thought when this report will come out, maybe the market should sell off, because stronger job market, higher wages, and that should give a reason to Fed to continue its tightening. But markets, like, they didn't bother. And other thing another one which I found was that wage pain. So it looks like even though we had more, added more employees, there is a little softening in the overall wage, right? So, which is what the Fed's reason have been over the past many quarters to continue to increase the rates. So, an interesting chart around some of the numbers that we had seen earlier, and which causes me to think, can you even believe these numbers? All these numbers that come out from BLS around the wages, hourly wages, how many job number have been added, because now the numbers are being revised. So if you look at a previously published real hourly compensation 0.7, now it's been revised to negative 4.7. So in fact, the hourly wages, instead of increasing, were actually decreased. And whereas the Fed was running all its policy based on those original numbers. So I don't know what to believe or what not to, right? So eventually it looks like we're going to have one more hike. Market is now starting to predict it, or not predicted, but market is starting to price in now one more hike for June. 4 weeks ago, the probability was 0. Now the probability is 70% that we will get maybe one more hike. Right? So maybe Fed will deliver us one more hike. But despite all these things, NASDAQ had 6 consecutively weekly gains, which I think is the best performance, I know, since August last year, or maybe even go further back. But we hit a new QQQ, hit a new 52-week high at 355, and it's up 34% for first 5 months. Right? At this rate, yeah, maybe could double by the end of a year. Haven't done that before though. In its history, QQQ has never doubled. I think the max it has done was what, 50% or 58%. I don't recall the figure. We looked at the table last week in terms of yearly performance of QQQ. Maybe I think it's between 50 and 60% per annum. So if 2023 is going to be one of those years, then we are only halfway through. We still have another, let's say, 20% for NASDAQ to go. But we don't know if this is going to be that year or not. So I'm being a little cautious. First 5 months, 30% up. First 5 months, SPY up almost 12.5%. I think that's good enough. Don't need to be too greedy for me right now. So sector-wise, all sectors look good. Real estate, IT, consumer discretionary, Teslas of the world. Overall, S&P was up, what, 3% for a week? That's like crazy. 3% for a week. I think over a month basis, S&P is probably it's 2.75%. But 3% in a week, that itself says what, 30, around 50% for the whole year. VIX got back to pre-COVID levels. Yeah, there is no fear in the market. And we see the fear and greed index is back to 65. Probably in the middle of the greed meter or greed scale. And here I just plotted the fear and greed and S&P. And we have always seen, once it exceeds around 75, we'll see a sell-off in the market. Again, greed start to set in. Again, there will be sell-off in the market. So this whole cycle will continue to go. Right. So looking at what I bought or sold, nothing. Nothing bought, nothing sold this year, waiting patiently. I do want to buy a couple of new takers, but no, I think one new taker and one wanted to add to my current position, but the market was so high and I've decided to hold on any purchases when the market is green, maybe buy on a red day. So I'll wait for markets to fall and maybe give me an opportunity. If it doesn't come, it's fine. There will be more opportunities to come later. Okay. What is VIX right now? I didn't check. Maybe it's what, 16? Less than 16. Let's see. What's VIX? Gosh, it's like 14. Let's say 3 or 1 day. Wow. It's like, yeah, everything is great in the markets. And that's what happens when everything is great. That's what market will surprise. So VIX is back to level haven't seen in many, many months. Now, we'll see. We'll see how it goes. Interesting. Profit booking maybe, but didn't see like a profit booking. Market has been going up. If you see the profit booking, then I should see the markets dipping. But yeah, could it happen in near future? I think the profit booking gonna happen only in some of these high-tech AI stocks, right? The rest of the stocks, the majority of the stocks haven't done much this year anyway. It's only a handful of stocks that have gone up. And right now there is so much of a FOMO in those handful of stocks. So I don't know who's gonna now say, okay, you know what? I think NVIDIA has run up too much too soon. I'm gonna sell my NVIDIA positions. Unless some of those, or let's say a Microsoft. There are, I think on a CNBC, there was an image called Magnificent Seven, a take on that movie, which is driving the whole market, which will include your Amazon, NVIDIA, Tesla, Microsoft. There were 3 others. I don't recall. So now someone has to buckle and say enough on those stocks. And those are the 7, 8 stocks that have been carrying the markets. So if we do a profit booking on those, yes, we should see markets to come down because there is not much of a support coming from a lot of other stocks. A few more graphics for you. A lesson for investors: change is inevitable. So please embrace it. As an investors, those who are young investors, young means in their investing journey, biologically it could be 50 years old, but if your investing journey you've been young, we have spent most of our life in a zero interest rate policy environment, but now we have to understand and embrace the higher interest rates. So pick up your stocks accordingly, pick up your investment thesis accordingly. You could shift your focus to the companies that make money right now or not gonna make money maybe 10 years down the line, right? That won't be worth much because now we have a higher interest rate. So embrace the change. We can't run away from the change. Other one Tona talk about is mental clarity. I think this is really, really helpful, at least for me in my life, is started to journal. Right? When you're looking to buy a stock, why would I want to buy the stock? What's the stock has done? What's my thesis on the stock? And that helps us to avoid all the noise, because there will always be noise. Now, if you go to YouTube and I find looking at all the videos that YouTube now suggests me are full of AI. So there is so much of a hype, so much of a noise in AI, right? But if you know why you bought a particular stock in AI, could be any stock. If you bought just on the hype and did not write down the reasons on why you bought it. What did you like about its business? What did you like about the company? What did you like about its management, or the products that they sell, or the customers they have, or the opportunity in front of them? Once the media narrative changes, it will be difficult to hold off to the stocks. And this has happened time and again. When the many investors just go with the stock price. If the market is going up, we tend to buy it. And when the market falls down or the stock price goes down, we tend to sell it because we did not have any thesis behind it. And that's the worst thing to do, right? We should be doing the reverse. We should buy it when the stock is at a lower price and sell it when the stock is at a higher price, right? And sell it because, hey, you also want to, you have you have a reason to sell it, not just because the price is high, but other reasons, right? We discuss the multiple reasons of when you should sell your stock, right? So build your thesis somewhere. If you write down and then in one particular day there's a lot of a chatter in the market about the stock, go back to your thesis and see, if your thesis have changed, maybe take an action. But if you haven't journaled anything, there's no thesis around it, then we'll be like a pendulum swinging from one extreme to another extreme based on what's happening in the financial media, which is the worst thing as an investor. Activision MSFT deal. Was there a new news around that? Did they call off the deal after UK nixed it? I don't see anything beyond than what had happened earlier. Yeah, UK blocked it, EU had approved it. Nothing, no more news beyond that. So I don't know, Naresh, what you really meant by this. Did they nix the deal? No. Okay, I don't see anything in the news. Oh, they are appealing. Oh, yeah, that we know. Yeah, they will appeal to UK government. That was known even when moment after they came out. So after a few days, Microsoft told that they're going to appeal it. Yeah, but that's a regular process. Right? Now with the EU approving it, maybe they'll have a better case, but we'll see. Finally, long term, this too shall pass. 2022 has passed. We have seen these corrections many more times. It's okay. Go back further, there are even worse corrections than what we are seeing in 2022. So don't be afraid. Stay invested. If your position size is okay, we'll all live and survive a few more of these corrections. But eventually, economy continues to improve. And if we are participating in that economy by buying stocks of good companies, not meme stocks, not hyped up stocks, but the good business stocks, life will be fine. Right. All right, let me sip some water. And now what else we have to cover? This is our first session after at the start of a month. So I'll give you a quick overview, as we always do, of my portfolio, what's changed in that. And I think then we're going to do a review of IPO. Anything else on your mind? And after IPO review, we can go through some earnings as well. So I guess those are the two big things. IPO and earnings. Or do you want to switch the order? Should we do some earnings first and then go to IPO? All right. Pizza portfolio, Pizza, how does that look like? End of May. Nothing much change, guys. No, not much change. This is not surprising at all that the NVIDIA has now gone up and made into top 10, and while the GLD is now out of top 10. Other than that, no change. It's still the same. Unless there are questions, Cash has come down a bit. I would say percentage wise, because the rest of the portfolio, the stocks and that rest of the portfolio has gone up in value. So the percentage contribution from cash has come down. Absolute value probably is higher, but I always focus on the percent numbers. Apple 5%. I think maybe I can take any individual company to max 10%. Rest everything is still fine. Amazon, QQQ, ASML. The newest one is NVIDIA. After this hype is over, probably it will fall down from top 10. Any questions on the portfolio? All right, let's move on. You added NVIDIA to my portfolio? No, I bought NVIDIA in, hold on. When did I first buy it? Wait. NVDA. First time I bought NVIDIA was on February 23rd, 2021. I bought 5 stocks of NVIDIA. Then few more I bought. Last I bought NVIDIA was in February 2023. So I've been buying NVIDIA for some time. Now it has become, I think after this whole 30% rise, it has become big enough to become top 10 position. But I picked a bunch of NVIDIA's last October. I started building position in 2021. So it's been 2021 Feb till 2023 Feb. After Feb of this year, I haven't bought anything. Oh no! Oh, sorry. No, the last one I bought was in December 2022. The Feb I sold a bit because I bought. I think my last time when I bought NVIDIA, it was $113 in October. I'm looking at my purchase. Yeah, in October it was $113, and then February it was $206. Right. So then I sold some at $206. Right. But I still holding the rest of NVIDIA in my portfolio. So that's where. But now it has become big enough to be in top 10. You didn't take profits. The whole idea is, when do you take those profits? No, so I'm not taking profit on NVIDIA right now. I mean, I'll hold it. I had a call spread which has been challenged twice, so I'll probably sell some to sponsor the call spread and gonna put another one. Right? I don't know how long this craziness can continue. Don't you think it's overinflated now? For me, I think it is overinflated, but I don't know what market is thinking. Right? So, still holding on to it, still weak. Covered calls. Yeah, I'm holding on to it, and I'll sell call spreads against it. Did you reduce GLD position? No, I did not reduce GLD position, just that the GLD did not increase as much as the rest of the stocks have increased. So I didn't sell any GLD. I think this year, I just have been doing closing, getting option premium around GLD, was trading around my long holdings of GLD. That's all I've been doing. I didn't have to sell anything. I didn't have to buy anything, but just that the gold hasn't performed as much as the rest of the stocks. So it is no longer a top 10. Hold on, let me see where it is right now. GLD. Where's my top 50 list? There we go. GLD is at number 12 right now. Okay. So yeah, I haven't sold anything. I mean, if I sell it, I generally come and tell you, okay, this is what I sold. this week. Like this week, I didn't buy or sell anything. Last week, I had bought what little bit of a BABA because it was like around below 80. It was 75, 76 something. I just paid a little bit of BABA. Nothing this week. What's your NVIDIA position? I have a long stock in NVIDIA. I have an iron condor in NVIDIA for July. And then I have a iron fly in NVIDIA for June expiration. And the call spread is way deep in the money. So I think now, because I have to buy back that call spread, I might sell a few share of NVIDIA to sponsor that buying back of the call spread. So then I'll report you next week. Okay, I sold a bit of NVIDIA. Dave, I'm holding my shares no more than 2 weeks. No, I can't do that. Dave, you are full time into this, if I recall correctly. Not the way that I work. Most of my holdings and the holding that I've done best for me so far are the ones that I've been holding for 3, 4, 5 years, and just trade around that using options. Alrighty, all set for new IPO review, or shall we go to earnings first? All right, looks like you're good with either. So let's go into IPO review, and then we'll spend some time on earnings. Okay, some of you might be looking at why do I hold these shares? Because I don't, again, I want to give my portfolio a time to compound and not cut short, not interrupted during this compounding cycle. And I don't know which stocks will eventually compound, right? So no one would have known that NVIDIA will go from $4 in 2004 to $400 in 2023. No one could have predicted that. So if you bought at 4, sold at 10, great. But then we missed from 10 to 400. So I've been trying hard. I mean, I've played that game earlier. So I played that game earlier, and then I realized a lot more of a work involved. And now and that's why I started looking at options. Is, hey, how do I can stay invested and without being fearful of, gosh, the stock could crash 20%. Until I knew that, I was in a position, hey, stock has gone up 50%, 20%, let's sell it, and then start looking for another one. So that's too much of a work. Every time you sell, selling involves 2 decisions and a lot of work, which is, hey, which one to sell and then which one to buy, where to redeploy the capital. So I decided to figure out a way in which I don't have to sell. Exceptional case could be like NVIDIA, if it is gone, or some other stock which has gone abnormally high, right? But otherwise, I would want to be patient, hold, and reduce the cost basis. Dave, I agree. I just don't have a patience for buy and forget strategy. But ultimately, long-term holders are big winners. That's what I see. Some of my stock account, which I don't use it, that's the biggest winner. Here's a wildcard. Buy INTC now, hoping it will be 100 in a few years. I have INTC, very small position. Only thing is that it's a strategic. It could be a strategic to US, but if TSMC is opening a plant here, who knows? But we'll see. I watch INTC and see their earnings, etc. But I do have a small position in INTC. Do you have any position in energy stocks? My energy stocks are not the individual. I don't have individuals, but I have a position in AMLP, which is a ETF on with energies. So, and the reason I got into AMLP is AMLP. It's a good dividend payer, and yeah, and number two is it doesn't issue K1. So I wanted to avoid the K1. Other
Vivek,
than that, not big position on energy stocks.
can you explain what's going on with TSMC in Arizona? Because I don't know. There's some news, some people commenting that U.S. is stealing TSMC's technology. What's going on? I don't, there's a lot of noise out there.
Maybe I didn't come across that. If that US is stealing, I won't be surprised.
Well, not stealing, but taking, TSMC won't be special after it goes to Arizona. Wasn't it supposed to go to Wisconsin a few years ago?
No, so I don't know, or maybe I don't recall. All I knew was, Arizona thing is what I was tracking. I don't know about were they planning to go to Wisconsin or not.
Oh, excuse me. Because when companies go to China, China it's in the country, so they have the technology transfer. So I guess what I'm reading is these 50 senators, China propaganda, they're saying if TSMC goes to Arizona, then they're going to have to come. They're going to have US will have their technology, then Taiwan won't be important and all that stuff.
That might be propaganda. Who knows what's true?
Oh, okay. Thank you.
Yeah.
Like, for instance, when companies go to India, do they only surrender that?
So there are different regulations, right, depending on a country. And when, India does had a protectionism for its own homegrown industry. So, for example, I don't know if now or not, but probably I think it's still there. You cannot be, let's say Walmart cannot go and open up a store for retailers in India without having an Indian partner with them, right? Because they do want to protect that industry. Similarly, in defense, you have to have maybe some sort of a technology transfer with an Indian partner, because the Indian government do want to protect that section of industry. But it is right up there and say, hey, if we want to have foreign investment in these sectors, these are the protected sectors and these are the conditions if the foreign companies want to come and participate in it. So long by India had a history of protectionism for decades. It started opening up its sector, I would say 1990. That's what the whole liberalization wave that came in. And then we could started to see a lot more, foreign brands coming in India. Those who are from India would recall there only used to be two brands of cars, right? Only two brands of cars in India. And if you want to buy a car, you need to book a car, and it might take 7 months, year for the car, more than a year for your car to be available. And then the sector liberalized. Same thing happened with mobile phones and all that. Slowly, India started to open its sectors for foreign investment. But even now, there are some sectors which are still protected. So US is pretty open in terms of business. And I would say as compared to other countries. I see they're interested in us using the fund. Very, very interested in exploring. Yeah, NVIDIA and Intel. Yeah, so I saw that NVIDIA and Intel news around maybe Intel could start making chips for NVIDIA, but Intel has to come to that. And I don't know what kind of chips are they, but Intel has been having its own problems over the past many years to make chips for itself, right? Their whole design process and all that is so integrated that while the rest of the world has moved towards 5 nanometer chips, India was still stuck at Intel, not India. Intel was still stuck at 7 nanometer, and that too got delayed. So yeah, I like the pact, but then they have to deliver to it. Yeah. Steve said there's nothing wrong with India to protect its own industry. Otherwise, the game will not be played in a fair ground. Yeah, I mean, every country goes through its own stage, I guess. And then India has been very cautious in opening their industries slowly and steadily. Right. So otherwise, I mean, when it comes to your retail, there are millions, tens, hundreds of millions of local retail shops you will see, which is where we'll go and buy. Before the formal retail store concept even came to India. I mean, that wasn't even a thing, let's say 20 years ago. We'll always buy from mom and pop shops. Now, what happens to those shops when, say, Walmart starts to come in? So yeah, they'll take their own time, and which is fine. All right, let's talk about CAVA. Anyone heard about CAVA, or anyone had food at CAVA? I've not seen any CAVA around my location. I don't know if they are in California or not. Has anyone have had any food eaten at CAVA? Can give us some boots on the ground research. So anyway, if you haven't heard this name, this company, the claim to be the Chipotle for Mediterranean food. I would rather call Subway for Mediterranean food. So basically, just like Chipotle or Subway, they'll have a bunch of restaurants across industry, but what they specialize in is the Mediterranean food, right? So 38 ingredients that could make overall 17.4 billion combinations, grains, greens, salad, tzatziki, hummus. I like Mediterranean food. I don't know about you, but at least we have not too far away, I think it's 2 or 3 miles, there is something called falafel hut. And they prepare the fresh, you go there, order it, generally it's crowded, but you can get a freshly made pita bread, freshly made hummus, and I generally go and just get a classic hummus plate. So this is what they want to be, and they will also have chef curated menu. Either you go and pick yours, or the chef can create a menu. Jay says, looks like CAVA is in SoCal only. We'll see. I think there's a map. But it doesn't say it's north or south. And you can do in-restaurant, digital pickup, drive-through, delivery, catering, CPG, consumer goods. So this is a letter from their chief executive. Maybe we'll spend 2 minutes, 5 minutes, maybe 5 minutes to go through the letter. This will give us some information around the history of the company. We trace our roots back to first generation trio of friends, sons of immigrants from Greece. I only gonna say the first name, okay? Ted, Ike, and Dimitri. Their friendship began in school cafeteria. And in bringing their dream to fruition, they navigated entrepreneurial missteps as they prepared to open their first restaurant from inadvertently using kitchen hood meant for a bakery. Okay. So they started their first restaurant in 2006 called CAVA Mese. And then, drawn to the ethos of Mediterranean way, guests of all kinds flocked to CAVA, often waiting hours for a table. Looking around, you could see families of small children, blah, blah, blah. With the popularity of first eatery and with the encouragement from their customers, they started to sell their dips and spreads in local grocery stores in 2008. That's where their CPG comes from. Consumer packaged goods. Looks like they do sell dips and spreads in stores. And this is from Brett Schulman, who is a CEO. So he said, I joined them a year later to help grow their packaged products offering. 2011, founded in 2006, 2008, selling hummus, got a CEO. 2011, opened our first CAVA, which is a chef casual format, not dine-in, but casual format, just like Chipotle's. The CAVA experience continues to resonate with the guest Our acquisition of Zoe's Kitchen in 2018 offered an extensive portfolio of quality real estate to convert into CAVA restaurant. So in their life, they've already done one acquisition of Zoe's Kitchen. Anyone heard of that Zoe's before? I'm not a big foodie, so I'm not surprised, but they bought a whole Zoe's chain. And we recently opened our 263rd CAVA location and expect to have 300 restaurants in 24 states and a DC by the end of this year. So that's their journey so far. Opened in 2006, started selling hummus in 2008, opened a casual restaurant in 2011. 12 years later, they have 263 restaurants, plan to scale it to 300 by end of this year. So that's a journey out here. They also launched CAVA Rewards, $13 wage. They are in now Whole Foods. Oh, maybe I'll go and check. So Whole Foods nearby to see how their hummus tastes like. Right, 3 founders. Summary is this. All right, business side. Let's look at their, rather than reading through the numbers, I'll just focus on this chart. So their restaurant count has been growing at 50% CAGR rate, which is huge. But my only worry is most of those restaurant count is coming from their acquisition. So this is a little bit of a misleading, if I can use that word, that you acquired a company and now you're rebranding those Zoe's Kitchen to CAVA. And then you're saying, okay, we are growing our restaurant count, CAVA restaurant count by that, right? Revenue has been growing at 52%, which is good, but this does include their acquisition revenue. In the for 2019, fiscal 2021, 22, first quarter 22, first quarter 23, the growth has been slow, but now 44.5% because of the revenue of the converted Zoe's Kitchen now start to come under CAVA brand. So again, 44.5 growth just doesn't, don't get too excited about it. That's coming from the conversion, right? All right, let's continue to look at what's the CAVA experience, what make it unique. We believe our guests shouldn't have to make sacrifices to eat better. With a variety of choices we provide, every order is built upon a unique combination of fresh flavors and textures. So they have a split of 55% for lunch, 45% for dinner, 65% is in restaurant, and 35% is digital. Would like to see digital higher. We source 85% of ingredients directly from growers and ranchers. So those are, they say we have a high quality ingredients. Other tailwind behind this is Mediterranean food is generally considered as a healthy food, right? So, and a lot of consumers now moving towards healthy choices. That's another tailwind behind them. What else? 80% of the guests will customize their food. They have a high income consumers. Growth opportunities. 263 is right now, but what's your opportunities? As of April, we are 263. We are anticipating to have 34 to 44 net new CAVA restaurant openings, and which will include 8 conversions as well. So 63 plus 34 make it around 300. Potential, they say we have a potential of maybe 1,000 CAVA restaurants. So that's the by 2032. In another 10 years, what they're looking is we could actually grow 3 times from where we will end 2023. Okay, grow within the existing market, not much. Then the idea is enter and scale new markets. We already talked about it. A significant market opportunity supported by accelerating consumer trends. US limited service restaurant is estimated to be $325 billion in 2021 and then they say they can get some slice of it. They haven't really mentioned how much of this 325 billion do they expect. Evolving customer preferences for authentic and ethnic cuisine, which is fine. Oh, there we go. Mediterranean category is estimated to be $40 billion, was $40 billion in 2021. And this year they made how much? 500, in 2022, they made $564 million of revenue. So still the overall market TAM is around 80 times of what the 2022 revenue was. So a lot of room to grow. Yeah, we talked about it. Mediterranean has been ranked as #1 best diet overall. Let's move on. Okay, so this is where they are. So they are in the West, but looks like it's only in SoCal. That's why I don't see it here. A lot of in Northeast, and they're planning to move towards New Jersey in 2023. What are they going to do with the money that they're going to raise? They don't know how much they're going to raise right now. Probably they're going to do an addendum to their S1 to fill in these missing numbers. But nothing surprising here. They'll use the net proceeds for opening new restaurant and general corporate purposes. Nothing shady out there. Believe me, we have seen some shady in 2021. Some of the IPOs had some shady purpose of how they want to use some of the the proceeds from IPO. I don't see that anything here. Looking at financials, statement of operations, which is P&L statement, good growth, but losses also increased accordingly. A huge increase in losses in 2023. So it's growing fast, but losses are also growing. So something that we need to watch out for. Cash flow side, the cash flow from operating is pretty small. What's around just 6 million, right? That's very small for a company doing 564 million in revenue. And out of that, half of it, more than half of that has come from the stock-based compensation. And when you talk about a net cash flow, forget about it. Sorry, free cash flow. They're not free cash flow by any means. They are down. They're negative 100K. 100 million when it comes to free cash flow. So cash and cash equivalents. This also surprised me. There's only $39 million in cash for end of 2022, right? And if you look at their expenses, their operating expense are $466 million. And the cash that they have available was only $39 million. Right? So something is not matching here. So I was a little concerned about that. Other thing that caught my eye was the preferred shares that they had issued to the tune of $662 million. And then when I read further down, then I realized, okay, how are they funding their operations? Most of the operations money that they need to run this restaurant is coming from the preferred shares that they are sold to investors. Now they want to go IPO. To me, it looks like they need to go IPO. It's not that they want to, it's like they have to go IPO. And maybe the investors, those preferred investors, will sell some shares. And because they have been funding the company, not the business itself has not been funding the company. Very less cash on the balance sheet. So looking at balance sheet, $39 million cash, receivables all fine. A lot of obviously, since this is a restaurant business, a lot of assets tied into property and equipment. That's balloon the balance sheet. What else? Looking at the management discussion and analysis, what does management think and tells us about their company? We had a cash and cash equivalents of $22 million as of April. So from December to April, they burned another $17 million. Now they have only $22 million of cash on available. So I guess they need money, right? For the 16 weeks ended April 16 and fiscal 2022, right? Which is from start of the year, or let's say after from December 26th till April 16th, they were primarily funded by cash flow from operations. I don't think that's a big one, but majority of that was funded by sale and issuance of the Series F preferred stock. So all their operations were funded by from the preferred stock. Executive team, except Ted, none of the founders is in executive team, which is a little surprising. Brett Schulman, who is a CEO, he is an early employee, joined in 2008, as we saw in the letter to share, in the initial letter, but not one of the initial founders. So I don't know where the founders are. Compensation perspective, executive compensation, compensation is overall $2 million, out of which cash seems to be $618K plus 17, that makes around 700. Non-equity compensation of 300. So almost million is 50% is on cash, which from my perspective is a little higher than what I would like to say. Looking at the options that they've granted to their executive, this caught my eye. I mean, something happened over here. We don't know what, that in a month, they had to reprice their option grant. So these options are granted at $22.66. And then a week later, those were all, a week later or 10 days later, those were all the option exercise price was like 8.81. Hold on. Yeah, which is a little fishy. I don't know what they did. So this is the preferred offering that they did. So overall, I couldn't find any information on who owns how much of the stock, which is unusual. Generally, there will be a table around statement of ownership, but there was nothing that I could find in their S1. So overall, my conclusion is this. I'm going to wait and watch for a valuation. We don't know how much money do they want to raise, at what IPO price do they want to raise. Most of the growth is coming from the brand conversion and not organically growing CAVA restaurants. 45% of the overall restaurant is from Zoe. So it's more than organic. This is an inorganic growth. I want to see more organic growth. Unknown insider ownership. I have a little concern on their cash position. I think they have to raise funds rather than they want to raise funds. So, and it's never a good position when a company is put in a, in the, where they have to do something rather than they want to. So I'm going to wait and watch. We'll still see how much do they want to raise, where do they want to price their IPO, and then we'll figure it out. That's on CAVA. After a long time, we got some IPO to review, quick 15-20 minutes review of IPO. All right, Jay shared some table, CAVA comparison. Ooh, so negative 3% return on invested capital. Okay, now that's okay. And then there is a link from new constructs. New constructs, I think I've read few of their or something else. What do they say? Don't bail out this CAVA stuff. Okay. So it looks like I have the similar opinion. Is hey, I don't want to buy in this one. I'll read through the new construct and see what their thinking is. I hope that article is not behind paywall. No, for now it shows me one of 4 free articles on Forbes. So maybe I'll read this. Maybe they have some different viewpoint which I missed but yeah, right now I don't want to buy into this company. All right, that's on the IPO side. Let's spend some 15-20 minutes on earnings. Cool. All right, first is up on the table is CrowdStrike. The shares market didn't like the CrowdStrike's earning, but let's look at the CrowdStrike, what they did. Let's go. Okay, let's come here right now. Total revenue increased 42%, which is a good thing, right? We want the companies to increase their revenue. Subscription revenue also increased 42%, which is fine. ARR, annual recurring revenue increased 42%. So nothing much change in the mix. It was better than analysts had predicted, but slightly better. Then gross margin was 78%, pretty decent gross margin. What else? Cash flow, net cash is 300 million, which is way higher than 215 million as compared to previous year. Cash and cash equivalents was 2.93 billion. Okay, a few other things. And I was listening to their earnings call. The CrowdStrike module adoption rates were 62%, 40%, 23% for 5 or more, 6 or more, 7 or more modules. So again, CrowdStrike strategy is the same. Get your foot in the door through your Falcon platform and then start selling more modules to the customer, right? Now we are seeing like they're around 60% of their customers have 5 or more modules. 2 years ago, this number was around like, we could see this for 3 modules. Now, 40% of their customers have 6 or more modules. And how can they not talk about AI? So they have to talk about AI. If you're a tech company and you're not talking about AI, that's a big no-no. So they did talk about Charlotte AI, which says, hey, I mean, I don't have to say much about it. I think they just said it because they have to say anything about AI. But other important thing was they got IL5 provisional authorization from Department of Defense. There are a handful of companies that have it in US, which is this is the highest level of authorization. Right now, it looks like they got a provisional one. Financial outlook is between 717 to 727 million for the full year, which the market, that's for the quarter, 717 to 727. For full year, it is around 3.0 billion to 3.03 billion. So overall summary was subscription ARR growth has slowed. So even though the subscription ARR growth was 42%, in a previous quarter, this was 48%. So overall revenue still grew, but the subscription part slowed down from a previous quarter. Market didn't like it. So if you recall, after earnings, the shares were down 10%, 12%, something like that. Guidance for the next quarter is around 35% growth at a midpoint, which is obviously 7% lower than what they grew this quarter. Also, the next year guidance is mid-30s, which is the slowest ever for CrowdStrike. So I went back and looked at hold on, let me just, I think I found another website. which I can go back and get, last 10 years of data and can extract it. I was able to do that. And when I was looking at that data, this 30% growth is the slowest ever in the history of CrowdStrike. I think that's why the market didn't like it. But for overall, we'll see. I'm still bullish on this from a long-term perspective. They've been hitting on the right, at the right levels at their customers and growing their business handsomely. I think the guidance from most of the companies have been very cagey because we don't know whether recession could set in. And that's why we're seeing a lot of these companies have been pulling back on their guidance. CrowdStrike is not the only one, but we'll see. So I do hold a bit of CrowdStrike in my portfolio, but we'll see how that performs. All right, next comes is Salesforce. Salesforce revenue up 11% year over year. Compare that with CrowdStrike. But CrowdStrike is at a much lower base. They were like $700 million per quarter, and this does 1,000 times more. 8.25 billion, 11% year over year. Remaining performance obligation is over 12%. That gives us some insight into, hey, what's going to happen for the next year as these RPO get converted into revenue. Many of these companies, especially these subscription companies, the way they recognize the revenue is when either the services are delivered or when the consumption happens. And so generally they'll recognize the revenue over a period of time. So if you sign a contract with, let's say, Salesforce, you might be signing a 3-year, 5-year long contract. I don't know what their contractual duration is, but you will not be able to recognize everything in that year. So you recognize over a period of 5 years. So that's the remaining stuff goes into RPO, which is called remaining performance obligations, means as and when the time passes, these 24.1 billion will get converted into revenue side. They also returned $2.1 billion to stockholders in form of share repurchase. They have 4.25 billion free cash flow, which is handsome 21% year over year, which is what Salesforce has been telling is, hey, we want to focus on margins. This is the year to focus on margins. This is the year to focus on operating more efficiently, which means cutting costs. I mean, it's a year of efficiency. That's what Mark Zuckerberg said, right? And so is all other companies. So good to see some increase in free cash flow. Margins improvement is the thesis. Operating margins is 5%. Don't like that. But it also included, 3% negative impact due to restructuring. Cash flow from operations was up, even while the stock-based compensation was down. So which means they really did better from operationally to get the cash flow. And they bought back stock and they also paid some debt, which is, as a shareholder, that's good. Right? But the stock has been through multiple places. If you look at the stock, has been all over the places in the last 3 years. Now it's back to where it was last seen in over here in 2021. Anyway, I don't hold any CRM in my portfolio, so we'll see. Anything on CRM? Otherwise, we'll move to Okta. Okta grew their revenue 25%, subscription grew 26%, RPO is only 20%. What does that tell us about future? Maybe future, do we expect the revenue to grow at a slower pace? Looks like, looking at an RPO, record operating cash flow and the free cash flow of $124 million. So every company, especially the tech companies, are now talking and emphasizing on margins improvement, on emphasizing on better, not throwing your bills into the fire, which is what most of these companies were used to doing. And yeah, subscription revenue grew 26% year over year, which is fine. RPO we talked about. Net loss, cash flow is 25% of total revenue. As compared to net cash operations is 19 million. So it means some portion of a cash flow. So this is, I'll rather take it with a pinch of salt, or rather a fistful of salt, right? The cash came from operations is only $19 million. Where did they get the rest of the cash from? Did they sell off something else? So this could be just one time bump in the cash flow, right? Maybe we'll open up its filing and see what do they say. Hold on. Okay, investor relations. Well, that's now giving me a little pause to figure out how did they manage 25% of the revenue converted to cash flow. Let's look at 10Q. What I want to look at is statement of cash flows. Come on. Hold on. Oops. Where did that go? Let's go back here. Oops, also was right there on the other tab. There must be a link to, there we go. Consolidated statement of cash flows. So cash flow from, that's a cash flow from operating activities 129. Is there some, what did the press release say? Something else? Net cash provided by no, that is different. Net cash provided operations was $129 million. Yeah. Geez, I've been reading it all wrong. So I think account receivables is 191. Net loss. 166 is stock-based compensation. Not good. So all the stock-based, so essentially in this quarter, they didn't pay their employees in cash. That's essentially what it is. $166 million is what they paid their employees in stock-based compensation. So, and then they were able to generate $129 million worth of operating cash flow, which is, come on, that's an eyewash. Okay, so I ignore that. Cash and cash equivalents 2.37 billion, which is fine. Outlook is 18% growth year over year. Now from growing 25% in this quarter, now projecting 18% for the next quarter. For RPO, you are projecting only 14 to 15%. And for a full year, you're projecting 17 to 18%, just like CrowdStrike brought their projection down from 40% to 30s, mid 30s. Okta brought down their projection from 25 to 17, 18s, and market really didn't like it. It was a weak guidance, and the stock got punished by 17, 18. I mean, if Friday was not such a strong day, wherein, hey, let's buy anything and everything which is under the sun, the stock would have been in a worse position. So I think it's all about guidance. at least based on this, what I see is all guidance. Weak guidance. Market doesn't like weak guidance. All right. Again, I don't own Okta as well. All right. Probably the last one is C3 AI. One of the favorites for trading in for retail investors. It has now become more like a meme stock. It has got the wonderful ticker of AI. You know, what better ticker can you find when the AI is the hottest sector? And no wonder, no surprises that after languishing for many months, we are suddenly seeing these spikes and then sell-offs and then a huge spike and then a huge sell-off and all that stuff. So let's look at its earnings, and then I'll have something else also to talk about C3 AI. It starts with generative AI changes everything. Overall revenue was $74.2 million. Subscription was almost 80%, so which is good. We want to see more and more of subscription revenue. They got a 66% gross margin, fairly decent. And RPO is around 381 million. What is the current RPO? Okay, cash balance, $812 million of cash balance. So total revenue for the fiscal year. So they have a weird financials calendar. So for C3 AI, this was their Q4. So not only they reported their quarter earnings, they also reported their full year earnings. So from a full year perspective, total revenue increased only by 5.6%. I mean, for a high growth tech company, we are growing only by 5.6%. That looks like a grocery store growth. That looks like a consumer staples kind of a growth. So despite all the hype in the stock, the financial year business, unless I made a mistake in copying, but hold on, let me just, this is really only 5.6%. Or did I goof up in copying? Financials, quarterly results, press release for Q4. No, it does say 5.6%. So I'm going to be careful. Business doesn't look to be doing that great. Subscription revenue is 86%, which is fine. But when overall revenue are growing out only at 5.6%, whereas the other companies like and at a basis of what, 266 million. It's not that you are a multi-billion-dollar revenue company. Like Salesforce does $40 billion revenue over a year. Yeah, they're growing at 11%, and you are doing 266 million, growing at 5.6%. Doesn't look good. Okay. Then there's a bunch of other stuff. They talk about 83% of the bookings were driven by application sales, and only 17% was by their C3 AI platform. I'm not sure how should I interpret it. This could be more of a custom built applications. Then it's more like a consulting kind of a revenue. Oil and gas continues to be the area where they derive most of the revenue from. And I'm not surprised because one of their biggest investor is Baker Hughes. And Baker Hughes is also one of their biggest customer, which kind of make me think twice about this company. Okay. In fourth quarter, they closed 43 agreements, including 19 pilots. Okay, so pilots, who care about pilots? And And these pilot sizes, what they've given, C3 generative AI, nothing much. Plan for profitability. Company continues on track with its plan for profitability with a goal of achieving a sustainably non-GAAP. Okay. If you want to talk about it, at least let's talk about a little bit of GAAP profitability. Okay. So non-GAAP profitability by next year, positive results to date, including 6.3 million free cash flow from business operations in Q4 financial year 23. So how did they arrive there? Did they revenue? Okay. No, cash flow. Whoa. So they lost overall on a $230 million revenue, and then they lost $268 million. Loss from operations is $290 million for a $230 revenue. What the heck? I can understand you're not making net profit. The cost of revenue is 180, sales and marketing 183, and then R&D is 210. Huge expense. Yeah, so basically they're spending more than $1 to make a dollar of revenue. Unsustainable. And another thing, we will be cash flow. Well, let's look at a cash flow. Where did that cash flow came from? So they had overall cash flow, they have negative cash flow, 16.3 million free cash flow. Okay, so they would have sold cash. Oh, this is not Q4, this is full year. Okay, so I don't think I have a Q4 here cash flow. But yeah, I'm a little concerned about this. Yeah, then their guidance is total revenue for the 2024 will between 295 to 320. So as we saw, they did around 250 in this year. So where's the revenue? They did around 230 in this year. So from 230 guiding to 295, which is what, 10%, around 230 to 295, 15-20%, which is fine. That's good. But then the stock got punished. I think there's a short report also around C3 AI, and I have my own concerns on C3 AI because I don't know what this company is about. What is C3 AI? And there are a lot of retail investors are so bullish about C3 AI, looking at the prospect of AI. But way back in 2008 or 2006, it was actually C3 Energy. And that's where they got in Baker Hughes as one of their investors, because Baker Hughes is in energy sector. So they branded themselves as energy company. 2016 or somewhere, or 2000, I can't recall, somewhere 14, 16, they rebranded themselves as C3 IoT, because market was all looking about connected cars, connected TVs, connected fitness machines, everything connected, big data, streaming and all that stuff. So they rebranded themselves as C3 IoT. And now in 2019 or 2020, they rebranded themselves as C3 AI, because now AI is hot. So I don't even know what's the next one. Is C3 AI gonna be C3 AI, or is gonna be C3 what's the hot in the market? So be careful. If you are invested in this, understand what they are doing and what they've done in past. Other thing is there has been misrepresentation about their sales team. How many people are actually selling their platform? So even in their S1, they have claimed that 12,000 sales force of Baker Hughes is there to sell C3 AI platform. And then in subsequent, I think their earnings calls and results, CEO has reiterated that we have a 12,000 sales force, 12,000 big sales force who is selling our platform. Baker Hughes says that they have only trained 60 people on C3 AI. So who's right? Overall, Baker Hughes might have 12,000 sales force, but are all of them selling their platform? Probably not. So then that causes us a misrepresentation. And right now there is an investor lawsuit that has been filed against C3 AI for misrepresenting certain facts in their IPO. And one of them is this 12,000 sales force, which the CEO has talked about multiple times. Now, Baker Hughes is the biggest shareholder and also one of the biggest customers. So is there some round tripping involved? I'm not saying that it is. I've not heard anywhere or read anywhere about it, but something to pay attention to is this is it does happen that your biggest investor invested in you and is also your biggest customer. How does that work out? And the other thing is 90% of the sales that were given to Baker Hughes is still sitting in account receivables. They're not paid money. So their account receivables have been growing at a much faster pace than their revenue has been growing. So it does like to think, is it just the revenue in the books? You really haven't gotten money and still sitting in the receivables? So that gives a little pause around C3 AI. I know from a stock perspective, probably it's a Vegas stock. You want to go and gamble, get some sugar rush, great. But if you really want to invest in C3 AI, I would encourage do a lot more due diligence. Or maybe you can find much better companies with much cleaner operations and a cleaner history than C3 AI. But if you're interested in, hey, I bought C3 AI at 25 and the next day it was 45, go knock yourself out. I wouldn't do that. And but you can do whatever you want to do. All right, last one looks like we have a Chewy. All right, anyone holding C3 AI or taking those gambling chips? Well, you could. I mean, I don't encourage, but if you want sugar rush, yeah, it's a way. I know this is pretty famous and a ticker among the retail investors. 45 million shares were traded. My God. And if you look at probably option volume for the which is our next standard expiration, June, not much. July, we do see open interest, 15,000 open interest for June, 7,000, 41. Anyway, knock yourself out. I'm not touching C3 AI. Chewy also came up with their results. And the interesting thing about Chewy is while the rest of their competitors like Petco, etc., had bad results, Chewy had a surprisingly good result. So rather than reading through it, let's look at the picture. Picture always says better, more information than the words. So net sales are up almost 15%. Good gross margin. They saw 90 bips improvement in gross margin. Net income, GAAP profitable income up to 22 million. Active customers is little bit of concern is active customers is still the same. Kind of 1% lower than what they were a year earlier. So they did see a drop of customers over this year. And I'm not surprised. Not every customer will be able to buy some of the expensive stuff that Chewy sells. But overall, I think I would still say 1% is not a big deal. Right? Free cash flow 127 million, which is 120 million up year over year. So that I need to dig into it. That is very unusual. And the reason why we are seeing now every company is trying to come up with a cash flow positive, cash flow from operations positive, FCF positive is what? Because the street wants to hear that. No longer growth story. We want to invest in the companies in these higher interest rates. We want to invest in the company that are generating cash. So now the companies are trying every method, legal method available in the book. It may not be the best one. It may be a little bit of hoodwinking, but they'll employ every method available to show that they're generating cash. So it would be good for us to deep dive into how they got from 7 million cash last year to 127 million. If it has come from cutting cost, great. But if it's come from doing some shenanigans, that's what will concern me. What I also like here is $512 net sale per active customer, which is great. $500 per customer sale is really huge. Right? And more importantly, 75% customers are on auto ship. It means they'll send you the boxes every month. I don't know what the frequency is. I don't own pets, so I don't have a need to use Chewy, but whatever the frequency is, maybe it's monthly. Every month you'll get the box. 75% of their customers get their box. So that's their good subscription revenue coming from, right? So looking at their balance sheet, $2 billion, so $408 million of cash, almost $400 million of securities, overall $1.7 billion. Out of it, 700 is inventory. So scrap that. It's almost $1 billion worth of cash and cash equivalents. Overall top line was better, but the bottom line blew away Wall Street expectations. So how much did they make? Net profit. Oh, this is balance sheet. I don't have a. Okay, we can go to Chewy website and see. The company had a free cash flow 127 million, and in the last 3 years they could make only 130 million. So this is interesting. Let's go to Chewy investor relations. I only picked up the press release. I didn't pick up the. Come on, does it have a link to PDF events and presentations? Shareholder letter. This should have. There we go. So net. Oh, this is all right. So net income is up 20% from a year ago, which is what it looks like. That was much better than expected. Other thing I wanted to look was what cash flow. How are they able to generate so much of a cash flow? Okay, there we go. Cash flow. So 22 million came from net income. 48 billion. $48 billion came from stock-based compensation. Okay. Okay, so they did good job in managing their receivables, taking care of their inventory, and So operation side 148. You move capex 21, you get a free cash flow. Okay. So they didn't do too much of a capex. Could that tell us something else? Could that be a short-term growth strategy? So the way we get a free cash flow is cash flow from operations, then net out the impact of capex. That's a free cash flow. So last year, their operations, they got $82 million, but then they spent 76 million in growing the business, in doing capex, in investing into the business, maybe more warehouses, maybe buying bigger servers. That was a capex. So this year, they didn't invest into the capex. So generally, your investment in capex, you will need it to grow your business in future, right? If you are forecasting a huge business growth in future, you want to make sure your business is set up to support that future growth. Now, we'll have to probably go through the details of why the capex was like only $21 million. Is that maybe this was just a one time, and which is like I signed a contract. No, but I don't know. But does give us, I think this is one of again bigger contribution of almost $50 million difference is coming from not doing the capex. If that is that I don't have to do it, the capex, and still run my business, is great. But if it is, hey, I want to increase the cash position for now, so let's not spend anything, we'll figure out later on how to expand our business, then it is not good. We don't have that information. The other thing is, even though they increased their stock-based compensation by almost 50%, right? From $25 million to almost $49 million, which is, again, you're not paying your employees in cash, and then you're not spending money in capex. You've been able to increase your overall net free cash flow from $7 million to $127 million. So I'll take it with a pinch of salt. Okay. But we'll see. Market liked it. Stock was up 21%, 22%. So that's great. Also partnered with Trupanion for pet healthcare. They didn't talk about it in this, or no, they didn't talk about it in the press release. Yeah. So we don't know what's the details of the partnership is though. Cool. So that's Chewy, and I think I don't have Zscaler. MongoDB. I think that's probably the last one, or no, I don't have anything on Viva. Yeah, this is really the last one, and we'll be done. So MongoDB revenue increased 29% year over year to up to 368 million, which is great. Net loss was only 54 million as compared to 77.3 million, which is great. Cash flow, they had a $1.9 billion in cash equivalents. Where's the free cash? $53 million as cash flow from operations, as compared to $11.6 million in a year ago. So again, revenue good. Gross profit is 74% gross margin. That is good. Net loss. So EPS is great. Earlier it was 1.14 net loss per share. Now the net loss per share is 0.77, and a decent cash flow. So both the top line and the bottom line, I think specifically this net loss number blew away Wall Street expectations. They were expecting bigger loss than what they delivered. Robust customer acquisitions, they added 2,300 new customers, which is up 22% year over year, and which is most in more than 2 years. So new customer acquisition, have a plenty of cash and a free cash flow of $51.8 million. Also, they raised its full year forecast. So I think, and finally, of course, we are positioned to benefit from AI. So you drop in the AI name, and then you say 200 of the new Atlas. Atlas is their product, which is their cloud-based database. They say more than 200 of the new customers are all using AI. That's it. It's done. You've done your job as a CFO or a CEO to prop up the stock price. So stock was up, what, 30%? If I got that right, 20%. It was up 30%, then I think oops, wrong one. MDB. Yeah, it was up more than 30%, finally closed down at 28% higher, right? So doesn't look to be, it's okay, but doesn't look to be 30% great. So I'll be cautious. I'm not going to chase this. I don't hold it, and I'm not going to chase this right now. So that's a MongoDB. A short seller squeeze. Oh, there was a short seller squeeze on MDB. How much short interest do they have? MDB. Short to float ratio only 5.7%. Doesn't look to be highly shorted stock though. So I don't know if 5.7% is, that doesn't look to be good enough to cause a squeeze, unless the number is wrong. But looking at the business, doesn't look to be a 30% higher, right? They added 2,300 new customers, out of which they said 200 customers are the AI customer. Okay, you can get some boost from AI, but I think the fact that they blew up the top line and bottom line and also raised guidance, whereas some of the other companies are being very cautious in that guidance. So Wall Street was looking for some good news, and boom, MDB delivered. So that's it. All right, I think that's it for today. Yeah, 15 minutes over time. Any last minute questions, thoughts? Okay, I have a question for you all. So last week we discussed coffee can portfolio. Did you do anything about it? Did you put anything in your coffee can? Which is like, I'm not gonna touch this for the next 15 years. Okay, Bob says not yet. Okay. All right. So I spent some time in looking at coffee can and how I want to make use of it. So I did come up with my list of, Bob says it's 65. Yeah, so I think for, again, not a financial advice, but for you need to generate consistent income. So rather than worrying about what will happen 15 years later. But I did spend some time looking at, okay, if I own, let's say 300 shares of this company, how much do I want to put in my coffee can? And then use the rest to maybe do covered calls and all that stuff, right? Because I do want to make sure that in order to generate option income, I don't put myself in a position wherein, oh gosh, I had 200 shares and I did 2 covered calls, and that stock was, let's say, NVIDIA, and then I don't have anything, or some other stock that has gone up too high. So I do want to reduce the cost basis, but at the same time looking at, hey, which is the bare minimum I do want to hold in my coffee can portfolio. So that's the exercise that I've started to do and say, hey, if I'm doing a covered call, should I only do 1? Should I do 2? That will be determined by what I'm going to put in my coffee can. So that's the exercise which I'm doing.
So what rule of thumb do you use to choose what's going to be in your coffee can portfolio?
So I want to look at the
I'm sorry, I missed last week.
okay. So we looked at the when you look at a coffee can portfolio, the idea is I'm not going to touch that stock for next 10 years, 10 to 15 years. Now, the criteria behind that is it's a good, solid companies, solid businesses that I want to own. And maybe I could add some little bit of a growth one into that as well. But it's all based on what the future business of the company could be, not on the stock price, but what's the business of the company could be in next 10 years, 15 years down the line. And do I want to hold that company for, I don't want to touch that company come what may happen. The reason I got more interested in this is a few studies that I think we also looked at some extreme case of coffee can portfolio. But many times we have recently came across many studies around how those some of the investors didn't make money because we got scared around when something happens in the market and sold off sooner and never bought back. There is another study which is general on mutual fund industry, is on an average for a mutual fund, if they say the mutual fund has returned 13%, on an average, the buyers of the mutual fund have only made 8%. And that was again a surprising stats that I saw. It is because the buyers get scared. They sell the stock, mutual fund when the funds value falls down, and then they buy back when it start to go up. Rather than, hey, if you had just held on to that mutual fund, you would have made 13%. So I was looking at trying to figure out which companies in our portfolio, which we want to hold for long term. And I mean, I would want to hold all my companies, but something which I'm not going to touch them, I'm not going to sell them. Doesn't matter that the stock has gone down 20%, 30%. And because I do options, I also generally sell covered calls. So what I was little jittery about is, hey, what if I happen to sell covered call on whole of my position, right? I don't want to end up into that, especially the ones which I'm putting in my coffee can. So look through the positions and say, okay, in this case, I want to hold maybe 100 shares in coffee can. So that gives me 100 shares. If I own 100 shares to do covered calls and reduce the cost basis. And again, something new which we're trying. So that was a objective. Good businesses, strong companies, good track record, and we see that in future the businesses, the market that they are in will continue to grow. Hope Congress doesn't change carryover cost basis. Yeah, if you're passing on to heirs, yes. We don't know. Inheritance tax and all that stuff. I'll have to start worrying about it. Maybe it's a few more, maybe a decade later. We'll see.
So which ones did you choose? Is it like Microsoft or what?
Yeah, so hold on. Let me go back to let's bring up that document. Okay. Which one did we look at? Yeah, so these are the ones. I think I added maybe a few more. I added AMLP. And again, when I say coffee can means it's not that I'm never gonna. So for example, let's say on SPY, I hold SPY in my portfolio. I will continue to hold it, right, irrespective of wherever the market goes. But does that mean I'm not going to sell a covered call? I will sell a covered call maybe against a portion of the holdings that I have here, right? But these are the companies which I said, I will hold it for next 10 years. Right? And let's say I have a Palantir, I have more than 100 shares. Maybe I will put 50% of my current portfolio Palantir into a coffee can and another 50% to reduce cost basis or trade in or whatever we want to do. Right? But I do want to make sure that I hold 50% and don't touch it. One other which is missing is really, so I went through the list of my portfolio and looked at which companies do I want to hold and how much of that I want to hold in my coffee can. When I did that analysis, it looks like 60% of my portfolio goes to coffee can, which gives me 40% is what I can play with, reduce cost basis, try whatever we want to try. So that was objective, because more than once it has happened with me that I sold off a shares and, of course, made money by selling the shares, but then lost out on a huge opportunity that came after I got out of the shares. So at this time, I do want to make sure that I put those in a can, which I'm not going to touch it for next 10 years. That's the objective. Cool. All righty. I guess that's it for today. Unless there are questions, anyone here done box spreads? Not in recent times. I think last time I did box spread was in 2021. And now I even forgot. I did box spread. I done only for a very specific purpose. I forgot what exactly was that. But that was a time when I had looked at the box spread and did it, but not in last 2 years, I guess. And now I don't even recall, because that's not one of my regular stuff in my wheelhouse. So don't even recall what exactly was it, what was the purpose, but it was for some specific purpose I did that. Cool. All right. Goodbye, everyone. And we'll talk again next week for lock-in gains. Yeah. Cool. So now what I started doing is to do a collar against my position, which I did. I think we talked about it. Last week's session, right? Collar and collar spreads, but I haven't done box spreads recently. Alrighty. Bye, everyone. And we'll talk again next week. Have a great weekend and a wonderful rest of the week. Bye-bye.